The Chicago Bears just hit an NFL record valuation of $8.9 billion, but the real story is the final leap to $10 billion. Most people look at Caleb Williams and see passing yards or touchdowns. Smart investors see a financial multiplier. We're breaking down exactly how a franchise quarterback unlocks specific revenue streams from stadium leverage to global rights that turn a legacy team into a financial juggernaut. It isn't just about the scoreboard, it's about validating a massive commercial strategy. It starts with protecting the asset. Frame the hiring of Ben Johnson not as a coaching decision, but as a risk management strategy for $1 billion asset. For the last decade, the Bears suffered from a failed quarterback cycle that cost them millions in wasted draft capital and stagnant brand growth. When a first-round pick busts, you don't just lose games, you lose the ability to market a face of the franchise. You also incur massive dead money costs by constantly firing coaching staffs and paying out the remainder of their contracts. That financial inefficiency drags down the bottom line. The 2024 and 2025 on-field turnaround reverses that trend. Williams throwing for 3,541 passing yards and breaking rookie records aren't just stats, they are marketing metrics that drive immediate consumer spending. We are seeing the direct revenue impact of a star quarterback through merchandise spikes and season ticket retention rates. More importantly, a winning quarterback allows the franchise to command premium pricing on luxury suites. Corporate clients pay significantly more to host guests for a playoff contender than a rebuilding project. This is the Caleb effect on the team's $629 million annual revenue. Winning teams don't just sell tickets, they sell hope, which has a much higher profit margin than loyalty. To secure this revenue, the front office treated the roster like an investment portfolio. Bringing in Keenan Allen and drafting Rome Odunze were capital expenditures designed to maximize the output of the primary asset. They invested heavily in the offensive line, adding veterans like Joe Thuney. In financial terms, that line isn't just a blocking unit, it is a comprehensive insurance policy on a 9-figure investment. Ben Johnson's system is the software that makes the hardware run efficiently. He could have taken other head coaching jobs, but he chose Chicago specifically because the asset was viable. By stabilizing the quarterback position, the organization stops bleeding cash on constant rebuilds. They no longer have to spend marketing dollars reintroducing a new savior every 3 years. Instead, they have a stable, appreciating asset that anchors the entire brand. This stability allows ownership to shift their focus from fixing football operations to aggressive commercial expansion. The roster is now a solvent asset class that generates reliable returns, setting the stage for much larger financial plays. But jersey sales are pennies compared to the real estate game. The primary vehicle for hitting that $10 billion valuation mark isn't the roster, it is the $5 billion Arlington Heights stadium project. For years, this development has been stuck in a bureaucratic limbo, with the franchise reportedly losing $10 million a month in potential revenue while waiting for approvals. This is where Caleb Williams shifts from a quarterback to a negotiation lever. In the high-stakes game of public financing, politicians find it incredibly difficult to deny infrastructure funds to a winning team. When a franchise is rebuilding and losing 12 games a year, approving $855 million in public money is political suicide. But when the quarterback is throwing game-winning touchdowns and the city is energized, the political will to keep the team happy skyrockets. Williams provides the leverage ownership needs to finalize the deal. Once the shovels hit the ground, the revenue floodgates open, starting with personal seat licenses. A PSL is essentially a fee a fan pays just for the right to buy season tickets. In a new stadium, this is the single largest source of upfront capital, capable of raising over $500 million immediately. This cash injection reduces the amount of debt the team has to service, directly improving net operating income. However, PSLs are a product of hype. You cannot sell a $50,000 license to a fan base that expects a losing season. The Caleb effect validates this purchase, convincing wealthy fans that the license is an investment in a decade of playoff contention rather than a donation to a struggling organization. Beyond the seats, we have to look at the building itself. Soldier Field is a memorial stadium, meaning the Bears have limited ability to sell naming rights. A new team-owned stadium changes that instantly. Industry estimates suggest naming rights for a premier NFL venue can command $20 million annually. But here's the catch. Companies pay for visibility. A building that hosts home playoff games in January is worth significantly more to a corporate sponsor than a building that sits empty because the team didn't make the postseason. Williams ensures the brand exposure that justifies the premium price tag. Then there is the non-NFL revenue factor. The Chicago Bears play roughly 9 or 10 home games a year. For the other 350 days, an open-air stadium in Chicago is largely a dead asset due to weather. A dome stadium in Arlington Heights, built on the hype of a winning team, transforms into a year-round cash machine. We are talking about attracting the Super Bowl, the NCAA Final Four, and massive global tours like Taylor Swift. Look at the Real Madrid model in Europe. By renovating their stadium to host non-football events, they increased commercial revenue by over 200%, pushing their total revenue past €1 billion. The Bears are replicating this model, aiming to turn a football team into a 365-day entertainment conglomerate. Once the infrastructure is set, the team equity explodes. We recently saw a glimpse of this when a minority stake in the Bears was sold, valuing the franchise at an NFL record $8.9 billion. That is a massive number, but smart money knows it is actually the floor. That valuation prices in the expectation of future success. To bridge the gap to $10 billion and beyond, the Bears are leveraging new financial mechanisms that didn't exist 5 years ago. The first major catalyst is private equity. The NFL recently changed its bylaws to allow PE firms to purchase up to 10% of a franchise. This is a game changer for liquidity. Previously, if an owner wanted to raise $1 billion for a stadium or expansion, they had to take on debt or sell a massive chunk of the team to another billionaire. Now, they can sell a passive stake to a firm, get an immediate influx of cash, and reinvest it into the business. For a team with a young superstar quarterback and a stadium plan, the demand from private equity will be insatiable, driving the share price up further. However, the real secret to hitting the $10 billion mark is the dynasty multiplier. In the NFL, sustained winning decouples a team's value from its local market size. Look at the Kansas City Chiefs. They play in a relatively small media market, yet Patrick Mahomes has turned them into a global brand, with a valuation that rivals teams in New York or Los Angeles. The New England Patriots were a regional afterthought before Tom Brady. Now they are an economic powerhouse. Caleb Williams offers the Bears the chance to combine this dynasty multiplier with the massive Chicago market size. If he delivers sustained success, the Bears don't just become valuable, they become the most valuable property in sports. We must also consider the Dallas Cowboys model. The Cowboys were the first franchise to cross the $10 billion threshold. They did it by merging a winning tradition with aggressive commercialization. The Bears are following this blueprint, but adding an international twist. Through the NFL's Global Markets program, the Bears have secured marketing rights in the UK and Spain. You cannot effectively market a generic team logo to a new audience in London or Madrid. You need a superstar face. Caleb Williams gives the Bears a marketable asset to export globally. This opens up untapped revenue streams in merchandise and international sponsorship that legacy teams without a star simply cannot access. Finally, the stability provided by the Ben Johnson plus Caleb Williams partnership allows ownership to play offense. Instead of spending every offseason firing coaches and restructuring bad contracts, the front office can focus on aggressive commercial expansion. They can develop the real estate around the new stadium, similar to the Battery Atlanta model used by the Braves, which generates $75 million a year in incremental revenue. When you combine $1 billion real estate portfolio, a global marketing strategy, and a winning on-field product, the math is undeniable. The jump from $8 billion to $10 billion requires a superstar to validate the strategy, and Chicago finally has the portfolio to match the valuation. Caleb Williams isn't just winning football games. He is the critical financial variable that validates a multi-billion-dollar real estate and commercial strategy. The massive jump from an $8 billion team to a $10 billion empire requires a superstar to anchor the brand, and Chicago finally has the diversified asset portfolio to match the valuation. If you want to understand the real money behind the scoreboard, subscribe to Revenue Racers right now for more.